Welcome to the Estate Planning Made Simple podcast by LSPN, one of the nation's largest and best estate planning networks. The information provided on this podcast does not constitute legal advice. All information, content, and materials available on this podcast are for general information purposes only.
All right. Thanks to everybody for joining us today. I think today's topic is a topic that's very important for multiple reasons. But what we're going to really focus on today is just kind of on a general scope. Why is tax planning important? What are some of the things that can be done in regards to tax planning from the estate planning and kind of entity formation front? And what's the value of that as you sit down and look at your estate plan and business planning in general? And then, in future podcasts, we'll be exploring the specific strategies, some of the different, tax aspects for income tax purposes, capital gains tax purposes, or estate tax purposes that can be beneficial for your specific situations. But today, again, it's just kind of an introduction to the topic, and because we're rotating through these topics, we'll be obviously revisiting tax planning multiple times. So, when it comes to tax planning, unfortunately, most Americans don't really have a sense of what that means. And the reason is because your average tax preparer at H&R Block or at TurboTax or even CPAs often never engage in proactive tax planning. So what exactly do we mean by tax planning? Well, it's one thing to prepare your tax return and file that, and your purpose for your tax return is to declare to the government what your liability is based on your calculations of your income. And then they're going to compare that to the information that they have regarding your income. And then there's a period of time where they can, possibly contest what you're declaring and what you've declared as opposed to their records. And if they choose to audit you, then, they have a period of time to do that, right? But there's kind of this dance that happens. And so when you do your tax return, the idea is that you can only declare what happened over the last year, what activities that you actually engaged in, where the income actually came from, and how the money was actually spent. We can't go back in time and change how those things happened. So when you sit down with your tax preparer, your tax professional, what they're going to help you to do is they're going to help you to look backwards and say, okay, how do we save you money based on your activities from the previous year? And how do we minimize the amount of tax exposure that you have to declare according to the law, right? And the tax code. Well, proactive tax planning is basically saying, okay, if we look forward to next year and we say, based on your current situation and what we can put in place and how we structure your entities and how the money flows, is there a way that we could possibly reduce your tax exposure of what you will be declaring on next year's taxes? And why does that matter? Well, it matters because a lot of times when you sit down with your tax preparer, there's only so much they can do. And then you end up having a tax bill because the activities that you engaged in for the previous year weren't enough to offset your taxes completely. So if we want to offset them further, there are structures, there are strategies that we can implement. We can put, different flows for the money for it to be able to accomplish different purposes or to be able to use in different, entity structures. Maybe you're paying, family members through your business. Maybe you're, setting up charitable planning structures. Maybe you're putting things in place to be able to avoid self-employment tax through having an S corporation or something similar. There are multiple structures that you can have in place that will change how you're treated under the tax code and what you have to declare and how you declare it. But you have to have those things in place beforehand in order to take advantage of them. And so the idea of proactive tax planning is looking at your current structure as an individual, as a business owner, and as a total part of your estate, and then helping you to be able to restructure things so that in the next year you can identify more deductions, or you can offset your taxes in a bigger way, or you can have income that's coming to you that's not going to be declared for taxes, right? And so, again, unfortunately, most people never get the opportunity to really engage in proactive tax planning, because by the time you sit down with your tax professional, with your CPA or whatnot, it's already in the new tax year. And so if you do have a CPA that's been helping you with proactive tax planning, that's great. You probably have had the opportunity to sit with them throughout the year before you get to the next tax year, and they've made recommendations on what you could do or why you could do or why you should do it in order to offset your taxes. But even then, a lot of times you miss out on opportunities to be able to engage in the proactive tax planning without having a complete planning team at your disposal, right? So it's often beneficial to have your financial professional, your CPA or your tax professional, and then have your legal counsel all sitting together and strategizing on how you could best avoid future taxes by structuring things in different ways. And that's really the proactive tax planning that we're talking about, right? And so, again, the wealthy, they take advantage of these things. They have, the ultra wealthy have what are called the family office. And the family office is a team that they've hired generally full time to just help them and to work within the family office and making sure that their wealth is preserved and that their wealth grows and that they're making sound and wise decisions for their estate and for their accumulation of wealth. And unfortunately, middle America just hasn't had the opportunity to have that experience in general. But in order to accomplish it, it really just requires having competent professionals that all communicate, that all get on the same page, and that you can communicate with on a regular basis to make sure that things are still in line for your needs, right? So we sat down with very large, impressive income situations, and we've been able to save hundreds of thousands of dollars on income taxes for these people. We've also sat down with, more modest situations where they're making maybe $50,000 to $70,000 a year, and we've still been able to save substantial amounts on their taxes for them, right? And so this proactive tax planning approach can be very beneficial. So that's the first side of it, is what we call income tax strategies or income tax planning, right? The second side of proactive tax planning is planning around capital gains taxes. A lot of times we don't realize that, they don't just tax us when we earn the money, and they don't just tax us when we spend our money, sales tax and whatnot. And they don't just tax us every year as we own our assets, property taxes, for example, but they also tax us when we sell property that we already own. And so any accumulation of value that's happened within our property, that's called capital gains. And if you've held the property for longer than a year, that's called long-term capital gains. And if you've held it for shorter than a year, then it's called short-term capital gains. Those capital gains are subject to taxes, and you declare it with your regular income taxes. But your capital gains taxes are on a different income tax rate. And so it depends on how much you have in the way of capital gains. That's going to determine what tax rate you have to pay out. At a federal level right now, capital gains tax rates max out at 20%. And then depending what state you're in, you have state income taxes on top of that, right? And so on the top tax level for capital gains in the state of California, for example, is close to 40%. In other states, it's a lot less than that. It just depends. But the capital gains get realized at the time that you sell, or, often where you sell or transfer the asset, then that is when you have to realize the gains. It's called a realization event. At that point, then you declare your capital gains for tax purposes on that year's tax return. And then, and then that's when it's due. And so, we have strategies that we can put in place. And, if you work with tax professionals that can plan ahead of time before you realize those gains, there are strategies to defer those gains so you don't have to pay the taxes right up front. There are other strategies where you can minimize those gains by offsetting them through charitable structures or by avoiding the realization of the gains by putting them through retirement planning structures. And depending on what strategies you choose to employ, there could be tremendous savings on your capital gains tax exposure by putting things in place before a sale or a transfer, or again, what we call a realization event, actually happens. So it's definitely worth visiting with somebody that knows what they're doing before you have a realization event in your life. This may only happen, once, twice, maybe 3 times in your entire lifetime. But when it happens, even those with, modest income, modest estates can realize very large amounts in the sale of a home, the sale of a business, the sale of a capital asset, and that they are exposed to tremendous taxes for one tax year. So it's worth getting the right help in that tax year to make sure that you're accomplishing and going after these things in the right way to minimize your tax exposure. The third type of taxes that when we talk about proactive tax planning that's important to do is planning around what we call transfer taxes. And so for those of you who are not familiar with transfer taxes refer to estate taxes, gift taxes, and what are called generation skipping taxes. And the idea is that, again, when you pass away, whatever you own is going to be subject to tax. And if you have over a certain amount of value, then the IRS or the government basically says that you are exposed, or you're responsible for paying estate taxes on that value. So right now, for citizens or resident taxpayers, you have $12 million of exemption for your estate taxes. That means that any estate taxes that would be due don't kick in unless your estate is over $12 million of value. That's for an individual. So if you're married, then you would have $12 million of exemption, and your spouse would have $12 million of exemption. So the reason that the transfer taxes are 3 different kinds of taxes, estate taxes, gift taxes, and generation skipping taxes, is because the government wants to catch you regardless of how the money is transferred. So if you transfer it at the time of death as an inheritance, they're going to count the value of all of your assets. And by the way, that includes, real estate, any business interests that you might own. It includes any, cash on hand, personal belongings, cars, boats, planes, you name it, right? And if you're a U.S. citizen, the U.S. is going to count your assets worldwide. So it doesn't matter whether it's just in the United States or whether it's offshore, all of your assets are going to be included and combined for that valuation. And if you're over $12 million, then the estate taxes start kicking in at 40%, which is very steep, right? And so just imagine, $12 million sounds like a very high benchmark. And especially if you're married, then that's 24 million, right? So it's a very high benchmark to have to meet. But the law will be changing in just a few short years. In 2025, the law is going down automatically because the law will be sunsetting to $5 million of exemption. And so instead of $12 million per person, it will be $5 million. Now, $5 million, especially, we do a lot of work with California residents, right? And there's so much taxes in California. That's why I'm using it as an example. We have a ton of our clients that are moving out of California for that reason, right? But when it comes to estate taxes, just imagine a client that has $1 million home. In California, that's not too hard to imagine. And you have maybe a couple $1 million of life insurance because you want to make sure your family's properly protected in case something happens to you, right? Replace your income and whatnot. And then you have, a retirement fund that you've saved up enough money. And if you don't have $1 million in retirement nowadays, you probably don't have enough to really get by in retirement, right? And so, now we're looking at, 4 or 5 million already. That's not including, any additional properties or business interests, anything else that would be counted there. And I know some of you are thinking, well, life insurance is not taxed. Why are you counting life insurance? So for purposes of income taxes, life insurance is not going to be taxed. When it pays out, your beneficiaries are not going to have to declare that payout as income for income taxes. But for purposes of your estate taxes, life insurance amounts, your death benefit amounts do count as part of your overall estate. And they can push you into limits that would then be taxable for your estate. So for example, if you have $1 million, $2 million of death benefit on your life insurance, that's counted as part of your 5 million in 2025 or part of your 12 million today, right? And so anything above the limit is then exposed to estate taxes. And the top tax rate is around 48%. And so it can become very expensive very quickly. And when we talk about estate tax planning or transfer tax planning, the idea is to then remove assets from your taxable estate, whether that be life insurance or whether that be residences, investment properties, maybe it's, stocks or some interest in a company. We can remove those assets from your estate by gifting during your lifetime. Now it's not part of your estate. But because the government wants to catch you either way, they're going to count it for gift tax purposes. So your lifetime limits for gift taxes is the same amount as your lifetime limits for estate taxes. That means that over your lifetime right now, you can gift $12 million without any tax exposure. And in any given year, you can gift $15,000 per person, per recipient, per donor, right? Per person that's giving per year. And that doesn't even have to be declared. So you don't even have to do a gift tax return and declare it. It won't count against that, $12 million of lifetime giving. But if you gift more than that $15,000 in a year per person, then you do have to declare it, and it starts eating away your lifetime exemption. So if I were to gift $10 million today, then I no longer have $12 million of exemption lifetime, right? I only have $2 million left. So that's how it works. The government's going to keep track of that. The IRS is going to keep track of that, right? And then in the end, when you pass away, whatever you end up having to your name is then going to be counted. But again, if we strategize, put plans together, often use irrevocable trusts and structures like that to remove value from the estate, then that doesn't mean that the family is going to lose out on it. It just means that it's going to be protected from being counted for estate tax purposes. And in future podcasts, again, we'll get into more of the details on some of these strategies. So that's kind of the general overview of what proactive tax planning means and why we want to engage in tax planning when you engage in your estate planning. Now, in previous years, if you were to go back to about 2010, maybe 2008, the estate tax exemption limits were a lot lower. They historically have never been this high. This is actually the highest exemption rates we've ever had in history. And historically, in other years, we've been as low as $1 million. We've been even lower than that previously. But planning your estate around estate taxes was very important for the average family. Nowadays, the average family is well below the exemption limits, and we don't have to worry about estate taxes as much in your regular family estate plan, family trust plan. But if you do have a larger estate, this is a critical time to do planning because the exemptions have never been higher and they'll be going down in the next few years. So nowadays, when people engage in their estate planning, it's mostly beneficial from avoiding probate and avoiding the costs and delays and administrative issues of leaving an estate that doesn't have a proper plan. It's also very beneficial to avoid family conflicts and other things like that. Tax planning becomes secondary, but that doesn't mean that you don't have a need for tax planning if you have a larger estate. It just means that for estate taxes, it may not be a top priority. but capital gains tax planning, income tax planning may also be an important part of the conversation. So if that's something that's interesting or important for you, feel free to reach out to us and we'd be happy to visit. And again, as always, join us on future podcasts. I don't know that we have any questions that have come in so far, but if anybody has any questions that they want to submit in regards to what we've talked about today, we'd be happy to address them now. All right, we do have one question that came in. The question is, if my CPA or tax professional doesn't agree with my attorney, then what do I do? And I think that's a great question. It's a fair question, because the reality is that sometimes there might not be agreement, right? The approach that a tax professional takes when they sit down with clients and they approach your tax return may not be the same approach as a tax attorney or an estate planning attorney would take when they're approaching your situation. That's why instead of having professionals that work in a vacuum, you actually want to have professionals that will collaborate together and have conversations together. And you can hear, why each of them are saying what they're saying. And at the end of the day, remember, you're the quarterback. So you need to decide what strategies you actually want to implement for your situation. But you surround yourself with competent professionals that can inform you on what your options are and why. And we've had situations where people have paid thousands of dollars, tens of thousands of dollars for tax planning that in the end resulted in nothing really, because it wasn't done properly. And whoever sold it to them really wasn't selling something that was of any value, and they were able to kind of pull the wool over their eyes. Well, that's very hard to do when you have 3 or 4 people in the room, right? And you have your financial professional helping you, and you have your tax professional helping you, or your legal professional helping you, right? And so, again, surround yourself with a good team, and that'll help you to stay away from those problems. All right, so we're going to go ahead and wrap things up for today. We appreciate everybody plugging in. Be sure to join us next week as we start this series over again, and we'll be talking about incapacity planning next week. And in the previous incapacity planning conversation, we talked a little bit about the importance of powers of attorney. In this future one, we'll be talking about the importance of planning for how to pay for long-term care and your options there. So thanks again for joining, and we'll look forward to talking to you again next week.
This has been Estate Planning Made Simple, a podcast by LSPN. Join us next week on Clubhouse and on all major podcasting platforms.